$40,000. That is what somebody paid for a box worth under $3,000, the one wedged between the drinks fridge and the phone chargers in a corner shop at 10 at night. And the $20 notes inside it are not that company's money. It says so every single year in writing to the Securities and Exchange Commission. This ATM charges a fee of $3.22. Do you accept? The number changes, the sentence never does. You accept, everybody accepts. That is the entire reason the machine is standing there and not somewhere else. You just paid $3.22 for notes the company never owned. Your own bank paid that same machine again for the same withdrawal and nobody mentioned it. And the biggest cost of running the thing is not the cash or the armored van or the engineer who fixes it. At the world's largest non-bank ATM operator in 2020, it was the shop you are standing in. It beat all three put together. The $3.22 is the only part of this transaction anybody asked your permission for. It is also the smallest part of it. $3.22. That is the average surcharge at a bank-operated ATM in the United States in 2025. Industry survey, not a filing. And it was measured at bank machines, not the one humming beside the fridge. Hold on to that because it comes back. You saw that number, you pressed accept. Here is what you did not see. The same button press generated a second payment from a second payer. Your own bank paid the machine's owner an interchange fee for the privilege of reaching your account. It never appeared as its own line on your statement. 2 revenue streams, 1 withdrawal. Say the shares plainly. In fiscal 2020 at Cardtronics, then the largest non-bank ATM operator in the world, surcharge was 40.9% of total ATM operating revenues. Interchange was 26.1%. Say the vintage out loud because it matters. 2020 is the pandemic year and surcharge-bearing volume collapsed. Interchange was 32.4% in 2018 and 37.3% in 2016. The invisible payer's share has been larger, not smaller. The per-withdrawal split was last disclosed for 2008, $1.17 of surcharge, 62 cents of interchange. That is 18 years old, and nothing comparable has surfaced in a filing since. Now look at it differently. You have probably assumed you were the customer at that machine. You are one of two and the other one never chooses. Your bank pays every time on every foreign withdrawal whether or not you hesitated at the fee screen. And neither of you is paying the party that actually owns what came out of the slot. $4.1 billion. That is the average outstanding balance of cash sitting inside NCR Atlio's machines across the year to December 31, 2025. Not a credit line, not a facility limit, a measured average of notes actually in the drawers. None of it belongs to the operator. The filing uses 4 words that should not be possible: no right or access. The company whose name is on the machine has no right to and no access to the money inside it. Beneficial ownership stays with the vault cash providers at all times. The one carve out the filing names is the machines serviced by its own cash-in-transit arm in the United Kingdom. Then the accounting consequence in the next breath. Based on the foregoing, the ATM vault cash and the related obligations are not reflected in the consolidated financial statements. $4.1 billion of banknotes in machines carrying this company's name on nobody's balance sheet at all. Say it plainly, a bank supplies the notes. The operator pays a monthly fee on the average outstanding balance. Under a floating rate formula, the filing describes only as a spread above various interbank offered rates. The filing will not say which rate. The older Cardtronics filings named LIBOR, that language was dropped and no filing ties the current cost to SOFR. So floating, market-priced, benchmark, unstated. The cost of the money itself is pegged to a number the company will not print. Now stand at the machine again. The notes it counted out to you were owned by a bank you have never dealt with, dispensed from a box owned by somebody else in a shop owned by a third party. The operator's stake in that stack of 20s was the rent it was paying on it by the month at a rate set somewhere it does not control. That is not a trick, nothing here is fraud, it is the structure. The thing you came to the machine for is the one thing the operator can never own. And rent has a price, that price is set by people who have never seen the shop. $39 million. That is what 100 basis points costs. NCR Atleos told the SEC that a hypothetical rise of that size in variable rates would add approximately $39 million to its vault cash rental expense for 2025. The year before, on the same basis, approximately $40 million. Gross of its interest rate swaps, and the filing says so itself, so say it out loud. Now the mechanism. The rent is charged on the average outstanding balance. Not on the machine, not on the transaction, on the money sitting in the box. So there are exactly two ways to make the bill smaller: wait for rates to fall, which no operator controls, or put less cash in the box, which every operator controls. They wrote it down. Cardtronics Fiscal 2020, Item 7A, page 69. It believed it could reduce average outstanding vault cash balances as interest rates rose by visiting ATMs more frequently with lower cash amounts. The same sentence names the limit. That ability is partially constrained by the incremental cost of more frequent ATM visits. And it applies only to North America, the filing says so. Now the age of it, that language does not appear in the NCR Atleos filings at all, searched, 0 hits. It is the clearest statement of the mechanism anybody in this industry has put on a filing, and it is 6 years old. You have stood in front of a machine at 11 at night that would not give you $200. You decided the operator was being cheap. You were right, this is the exact shape the cheapness takes, and it is written into the cost of the money. Which is the strange part, because that cost is nowhere near the largest one. 45.3%. That is merchant commissions as a share of what it cost Cardtronics to run its ATMs in fiscal year 2020, not a share of revenue, a share of cost. The shop takes 45 cents of every dollar it costs to run the machine. The armored trucks take almost 14, renting the money itself takes 9. Now add up everything you assumed was the business. Renting the cash, 9.4, the rest of the cost of cash, the armored trucks and the counting, 13.6. The people, 10.7, the repairs, 10.9, 44.6%. The shop owner beats all four put together, barely, but he beats them. That was the last full year anybody had to file this. Nobody has published the breakdown since. And the base is narrower than it sounds. It excludes depreciation of the machine, and fiscal 2020 is flattered by a $35.1 million UK business rates recovery that shrank the denominator and lifted every other line. Then again, in fiscal 2017 the merchant's share was 50.3%, half of every dollar of cost. The caveats move the number, they do not move the ranking. You assumed the shop was a passive host, a place to put the thing. The filing says otherwise. The operator pays a variable fee for allowing us an exclusive right to place our ATM at their location. Exclusive, that is the word doing the work. The machine can be bought from a manufacturer, the doorway cannot be manufactured at all. So the shop owns the doorway, a bank owns the cash. What exactly did the guy who bought this route pay for? $2,767. That is the hardware value of one installed ATM, and it is the only such figure a filing will give you. When Cardtronics bought EDC in 2011, over 3,600 machines, property and equipment was fair valued in the purchase price allocation at $9.96 million, divided out. Derived, not disclosed, and an upper bound, because that line may hold assets that are not ATMs. Nobody will tell you what a new one costs. Not a filing, not a government report, not a franchise disclosure document. Trade press quotes numbers, the filings do not. So that 2,767 is the only hard number anybody has ever attached to an installed machine, and it is not a price tag. It is an accountant's leftover divided out after the fact. Now the cash, you have assumed the operator's own money sits in the drawer. Mostly it does not, and not only at the giants. Access to money, an independent deployer with 11,265 transacting ATMs told the SEC in 2009, "We do not use our own funds for vault cash but rather rely upon third-party sources." It rented from Elan Financial Services at a rate tied to Prime. That is 17 years old, and no pure-play independent has filed the like since. Look at what renting required. A letter of credit in Elan's favor of not less than $800,000, which had to stay funded for 90 days after the agreement ended. That is the gate, $800,000 of collateral to borrow money you will never own, posted by a deployer with 11,000 machines. Below that size nobody files anything, so you fund the drawer yourself or the merchant does. Then the running costs, which are the only ones anybody quotes you. Communications, 3.9% of cost on the fiscal 2020 Cardtronics stack and no fresher. Everything else in this business arrives on somebody else's calendar, and Cardtronics never quantified a single one of them per machine. Add it up and the price of admission buys you a box and a rented drawer. It does not buy the one thing that decides whether either of them earns anything. Subscribe, $800,000 of collateral to hold money you will never own, and that is still not the expensive part of standing in that shop. And one for the comments, the highest fee a machine has ever asked you for and whether you paid it or walked away. Almost nobody walks, that is the number this entire industry is built on. 256. That is how many cash withdrawals the average machine in Access to Money's fleet did per month in 2009. Stand in the shop again and count them, 8.5 people a day, and one of them is you. Cardtronics machines did 756 a month in 2019. Different companies, different years, no clean comparison. But the hardware is close to identical. What differs is the concrete it stands on. The machine is not the asset. You have assumed the operator is paid for supplying a machine. He is paid for occupying a corner and he does not own the corner. Access to Money took $2.43 of gross transaction-based sales per withdrawal. $1.73 of that went to the merchant. 70 cents stayed with the operator. 71.1% of that deployer's transaction sales went to the people who own the floor. And the split does not sit still. Cardtronics described the fee as varying by arrangement type, by location type, and by the number of transactions on that machine. Busier corner, bigger cut. The corner captures its own success. So what is bought and sold in this industry is not machines, it is contracts. And contracts end. Which is why the operator's real ambition is not a better corner. It is a payer who is not standing at the machine at all. 22.1%. That is the share of Cardtronics' total ATM operating revenues in fiscal 2020 that came from a line called bank branding and surcharge-free network revenues. $230 million, not 1 cent of it charged to a cardholder. Over 55,000 machines in the Allpoint network. 1,200 banks, credit unions, fintechs, and card issuers paying to be on them. And on 27,000 more, a bank pays extra just to put its own logo on the front of a machine it does not own, does not fill, and does not fix. Roughly 500 financial institutions did exactly that. Fiscal 2020 counts, and nobody has published fresher ones. You dipped your card and the screen never asked you for $3. Now look at it from the other side. A bank is buying access to its own customers. It pays the operator a fixed monthly fee per cardholder or a fixed fee per transaction, so its depositors can withdraw cash from a machine the bank does not own, staff, fill, or repair. The rate is not filed. Cardtronics described that mechanism in every annual report from 2008 onward and never once disclosed the price. Say that out loud because it is the number you would most want. So the free machine is not charity, it is the machine with a contracted payer instead of a hopeful one. And the pandemic flatters that 22.1, which is the whole point. Surcharge volume collapsed, nobody came to the machines. And the bank fees arrived anyway on schedule because the payer who never stands at the machine never stops paying. The same line was 16.0% in 2019, restated from 15.8 in the earlier filing, 13.9 in 2018. And all point alone is never broken out, it sits inside that combined caption throughout. Rising just not that fast. And the logo on the fascia is the premium product which tells you who this industry actually competes for. It is not you. It is also no protection at all against the one counterparty that never negotiates, a date. Approximately 5,000 machines. That is how many ATMs Cardtronics reported as not in service at the end of 2017, still sitting on the books with remaining net carrying value. The filing attributes that idle fleet jointly to the EMV upgrade and the loss of its largest customer, 7-Eleven. Jointly, EMV alone cannot be isolated from it. Say so out loud because the number is doing work. You have probably assumed a machine leaves a route when it wears out. Mostly it leaves when a deadline arrives. EMV was not one deadline, it was 3, and Cardtronics' own filings name them separately. Then, a second deadline, March 15, 2012, the accessibility standards became mandatory for new construction and they cover cash machines by name. Cardtronics said some of the shop-owned machines it serviced did not comply, so it sold those shop owners replacement units which showed up as higher ATM product sales in 2011 and early 2012. Somebody's compliance cost is somebody else's revenue line. Then the operating system. Microsoft support for Windows 7 ended January 14, 2020. Cardtronics told investors a large number of its ATMs ran Windows 7, that it expected to upgrade or replace a portion of the fleet, and that the cost could be significant. It never gave a number, no filing does. If somebody quotes you a per-machine EMV or Windows cost, that figure is not in any annual report. And the deadline that has actually emptied this industry was never on a compliance calendar at all. 5.2 billion. That is how many cash withdrawals came out of American ATMs in 2015. 4.7 billion in 2018, 3.8 billion in 2021. 3.4 billion in 2024. Same series, same table, same release. A 35% collapse in visits. Stand in the shop and look at the queue that is not there anymore. Now the other column. The average withdrawal went from $134 to $155 to $202 to $210. Nominal dollars, the Fed does not inflation adjust. And the total value pulled out of those machines, $0.70 trillion in 2015, $0.72 trillion in 2024. Read that again, the money did not leave, only the visits did. You have probably assumed a shrinking ATM business means shrinking cash. It means fewer of you, each one carrying more out of the slot. And the Fed has quietly rewritten this table more than once already. That $134 for 2015 is a 2026 restatement. The Fed printed $146 for the same year in 2019 and $122 back in 2016. 2018 lost 400 million withdrawals between two editions of the same release. The Fed has not published a reason. Here is the problem: the machine is paid per visit, not per dollar. The surcharge does not scale with the withdrawal. A $210 withdrawal earns the operator exactly what a $100 withdrawal earned. And the machine costs the same either way. Cardtronics withdrawals per machine per month fell from 756 in 2019 to 595 the year after, and revenue per machine with them from $1,105 to $956. Managed services machines excluded, pandemic year say both out loud. The cash is still moving, the transactions are not. And there is one cost that does not care how many people showed up, it shows up anyway, in a truck. 13.6%. That is the share of what it cost Cardtronics to run its machines in fiscal 2020 that went to a line called Other Costs of Cash. $89 million across the three disclosed segments. The filing gives this line by segment only, so that total is addition, not a filed number. Armored carriers, cash preparation, every note in every drawer was driven there by somebody paid to carry it. Set that beside the rent on the money, vault cash rental 9.4%, $61.5 million on the same segment sum basis. Moving the cash cost more than renting it. And the moving number understates itself because Cardtronics' own UK cash-in-transit arm was booked into another line entirely. Fiscal 2020 again, and the same $35.1 million UK business rates recovery shrinking the denominator. Say both out loud because they lift this line too. NCR Atleos does not publish this table at all. Here is what makes the van expensive rather than merely necessary. The operator does not own what is in the truck and carries the risk anyway. The cash is insured up to certain per location loss limits and subject to per incident and annual aggregate deductibles through a syndicate of multiple underwriters. Somebody eats the deductible, it is not the bank whose notes went missing. And it is a fleet-sized pile to be responsible for. Cardtronics averaged approximately $4.0 billion of vault cash in fiscal 2020. Atleos averaged $4.1 billion in 2025. Different companies, different bases, no single total, but the size of the thing nobody owns has barely moved. RAM raids, jackpotting, no filing gives a loss figure, so there is no number here. Now put that beside the visits, fewer of them, each one larger, and a cost line that scales with visits rather than value. Which is why this industry's answer stopped being a cheaper van a long time ago. Its answer is a bigger owner. $2.674 billion. That is what NCR actually paid for Cardtronics, not the $2.5 billion enterprise value in the press release. The audited figure, $1.775 billion to shareholders, $809 million to repay Cardtronics' debt, and $90 million in transaction costs, converted equity awards, and the settlement of pre-existing arrangements. It also paid $33 million on Cardtronics' behalf to break a prior agreement with an Apollo-affiliated buyer. Nothing in the shop changed: the fridge, the chargers, the machine, only the name on the deed. Then NCR took itself apart. 2 years later it cut itself in half, renamed the rest NCR Voyix, and pushed the ATM business out the door on its own as NCR Atleos. The machine in that corner shop changed owners twice in 5 years. And in February 2026, Atleos agreed to be bought by Brinks, $6.6 billion all in. $2.2 billion of that in cash, 13.3 million Brinks shares, and roughly $2.6 billion of Atleos debt taken on. Shareholders approved in June, no completion has been filed since, say that out loud too. You have probably assumed a fleet of machines is priced by the machine. It is not. Cardtronics said so itself in its 2004 registration statement. It values acquisitions on cash flow and the remaining terms of merchant contracts, not on any benchmark value per machine. The documented range proves it. Under $3,000 a machine for merchant-owned routes, derived and blended across 3 deals in one filing. Around $40,000 a machine for company-owned, bank-branded convenience store placements, derived the same way from the same era of filings. Same object, more than 10 times the price. The difference is not the box, it is the paper wrapped around the box. So the machine in your corner shop is not a machine. It is a line in a portfolio held by people who have never seen the shop, and it will be sold again, which is a strange thing to keep doing with an asset being squeezed from both ends at once. Subscribe. Somebody paid $40,000 for a box worth under $3,000, and what is eating that trade comes from two directions at the same time. 1.8 billion withdrawals. That is what disappeared from American ATMs between 2015 and 2024, not a forecast, subtraction from one Federal Reserve table. Then Cardtronics lost a single customer. 7-Eleven walked, and at the end of that same year approximately 5,000 machines were sitting idle, still on the books, still carrying value. The filing attributes that idle fleet jointly to the contract loss and the EMV deadline and does not separate them. Say so out loud. Read that again: one merchant, one deadline, and a fleet standing still. That is what it means to own the box and rent the doorway. The contract comes up for renewal, the merchant has read the surcharge sticker too, and somebody else will always offer him a bigger split. And the money underneath is rented at floating rates, hedged only in part. Atlio's own risk factor calls the current vault cash rental expense high, and the one lever anybody has written down, fewer notes, more visits, carries its catch in the same breath. So costs move with rates and with regulation, both of which arrive from outside. Revenue moves with a transaction count that has fallen for a decade. Running the machine harder does not open either jaw. It only wears out the part you own. So what does one machine actually put in your pocket? 70 cents. That is what one independent deployer kept per withdrawal after the merchant's cut. 2009, nothing comparable has been filed in 17 years. At 256 withdrawals per machine per month, that is about $179, derived, not a line anybody files. And it is revenue, not profit. Cash, processing, repairs, insurance, and compliance all come out of it. So tier it. One machine in a venue you already control. You are the merchant. The commission that normally walks out of the door, 71 cents on the dollar at the one independent that ever filed it, stays with you because you are paying yourself. That is the only tier where the largest cost line in this industry is not a cost at all. But no filing breaks out a single machine. Nobody files what that one earns. 10 to 50 machines. Nobody at that size files anything, and no ATM route franchise disclosure document exists in the public record, so run it off the only numbers that do. 70 cents a withdrawal, 256 withdrawals a month, 20 machines. About $43,000 a year in revenue before cash, processing, repairs, insurance, and the next compliance deadline. Both inputs are one company's 2009 numbers, and the arithmetic is mine, not anybody's filing. Say that out loud because it is the tier being sold to you. It is also the only tier nobody is required to show you a book for. Ask why. Platform scale is the only tier with audited economics. $956 of revenue per machine per month before the merchant's cut, $617 of cost. $339 of adjusted operating gross profit, 35.5% before depreciation, corporate cost, interest, and tax. And say the vintage out loud. That is 2020, the pandemic year when revenue per machine had already fallen from 1,105. 3 tiers, one set of books. And not one of them measures the machine you actually stood in front of. $2.24. That is the one time a government measurement ever separated the independent operators from the banks and published what their machines charged. 2012. Nobody has measured it that specifically since. Every current surcharge figure, including the $3.22 you started with, measures bank machines, not the one humming beside the fridge. Go back to that shop, the screen, the button you pressed. The notes were never the operators. They were the vault cash providers at all times, on paper, in an audited footnote, and on nobody's balance sheet at all. At the last pure-play independent whose numbers ever reached a filing, 71 cents of every dollar of transaction sales walked straight to the shop. And your bank paid a second time, invisibly. In the lowest year Cardtronics ever disclosed, that invisible payment was still 26.1% of its ATM operating revenues. Fewer of you every year, each one carrying more, into a machine that is paid by the visit. So say it plainly, you did not get overcharged. That is the wrong word for what happened. You paid the smallest, latest, and least interesting line in the transaction, and you were the only party in it who was ever asked to agree. An ATM is not paid to give you your money. It is paid to stand where you will need money, holding cash it does not own, and to charge everybody else first. Subscribe. There is another business you have already paid for without ever being its customer, and it is next.